Most traders don't go broke because of bad markets. They go broke because they hope. Hope is the most expensive emotion in trading, the one amateurs mistake for patience. They stare at a losing position and whisper to themselves, "It'll come back." Professionals don't whisper, they cut. They know that the market doesn't care how long you've been waiting, how confident you are, or how much research you've done. The market doesn't owe you anything. Jesse Livermore once said, "The desire for constant action is responsible for many losses." But if he traded today, he might add, "The desire for hopeful action is worse." Hope is the subtle poison that kills accounts slowly, trade by trade, until the trader no longer recognizes the damage being done. I once knew a trader named Alex who bought Tesla at $280. He was convinced it would soar back to $400. But when it dipped to $250, he told himself it was just a healthy correction. Then $230 still, temporary. When it slid to $210, he told himself, "It's oversold now. I'll just wait it out." Weeks later, exhausted and broken, he sold at $190. The stock bounced days later, but he was already out not just of the trade, but out of conviction, out of discipline. Hope had burned him from the inside out. He didn't lose only money. He lost trust in his own judgment. That's what hope does. It disguises itself as patience until it drains your psychological capital completely. Professionals never let it get that far. They define their risk before the trade, not during it. They decide how much pain they're willing to endure before they enter. That's the difference between a speculator and a gambler. A gambler negotiates with the market mid-hand. A speculator already knows his exit and he sticks to it. You'll never hear a professional say, "I'll see what happens." That phrase belongs to amateurs, the ones who confuse flexibility with faith. Hope creeps in because the human brain hates to admit it's wrong. Cutting a loss feels like failure, but the professional knows that cutting a loss isn't failure. It's insurance. It's the cost of doing business. Amateurs, on the other hand, think of every trade as a test of ego. They want to be right, not profitable. That's why they average down, double up, or widen stops. Each move is a plea to the market. "Please, make me right." The market, indifferent and efficient, rarely grants that mercy. Livermore's career was built on one principle: discipline first, conviction second. When his positions went against him, he didn't justify them, he studied them. "There is nothing new on Wall Street," he wrote. "Whatever happens now has happened before and will happen again." He meant human emotion, hope, fear, greed, the same old actors wearing new tickers. And yet, every new generation of traders falls for the same trap. They think their story will be different. They think they'll be the one whose losing stock turns around. They think their gut will save them. It never does. Think about it this way. If hope were a valid strategy, no trader would ever lose. The market would reward persistence instead of precision, but it doesn't. The longer you hope, the deeper the hole becomes. Hope is the bridge between denial and disaster. Professionals cut the bridge early. Amateurs build a house on it. The act of holding a loser doesn't just cost money, it corrupts your process. It teaches you that rules are optional. It tells your subconscious, emotion wins here. And once that belief settles in, every decision becomes tainted. Every future trade becomes emotional. The professional mind works differently. They look at a losing position and ask one question: if I didn't own this right now, would I buy it? If the answer is no, they're out, instantly. That question cuts through ego, attachment, and story. It reduces the market to what it really is: a probability game. And in probability, hope has no math behind it. You either have confirmation or you don't. You either follow your plan or you surrender to emotion. There's no middle ground. But let's talk about why hope feels so seductive. It's because it mimics patience, which is a real virtue in trading. Professionals wait for setups. Amateurs hope through them. Waiting is active. Hoping is passive. Waiting means you're observing the tape, analyzing risk, watching for pivotal points. Hoping means you're paralyzed staring at the screen, convincing yourself that time alone can fix your mistakes. Waiting is a position. Hoping is an escape. When markets turn red, amateurs think, if I just give it more time. Professionals think, if this wasn't part of the plan, I'm gone. That's the difference between losing small and losing everything. You see, hope doesn't just kill your current trade, it steals your future trades. Every minute you're trapped in a bad position, your capital and attention are frozen. You miss clean setups. You hesitate on fresh opportunities. You're emotionally hijacked by the ghost of a losing trade. That's the hidden cost of hope, not just financial, but mental. Hope feels safe because it avoids pain. But in trading, the avoidance of pain is the creation of more pain. Professionals embrace small, controlled pain through stop losses. Amateurs avoid small pain and end up with catastrophic pain. The irony is brutal. The discipline that feels hard in the moment is what saves you later. The comfort that feels good in the moment is what destroys you. That's why pros say, cut losses fast. It's not just about money, it's about momentum, confidence, and control. There's a phrase among floor traders, your first loss is your best loss. It sounds cruel, but it's survival logic. The first loss is the cheapest lesson you'll ever get. Every time you override your stop, you're teaching your brain that rules don't matter. And when your brain stops respecting rules, the market takes everything from you piece by piece. So how do you fix it? You replace hope with protocol. Before every trade, write 3 numbers: entry, stop, target. Those are your boundaries. Once you're in, you follow them, no negotiation. If price hits your stop, you're out. If it hits your target, you trail it or bank it. The point isn't to control the market, it's to control yourself. The market's job is to test your conviction. Your job is to defend your capital. Let's return to Alex, the Tesla trader. After that painful loss, he took a break. We reviewed every trade he'd taken over the last 6 months. Every losing trade had one common thread. He moved his stop or ignored it entirely. Every winning trade followed his plan. The pattern was obvious, but he'd been blind to it because hope had fogged his mind. Once he realized it, he changed one thing. He preset his stop loss before entering and swore never to move it. Over the next 6 months, his win rate didn't skyrocket, but his retention did. He stopped blowing up. His equity curve flattened, then slowly climbed. Hope had been replaced with habit. That's the essence of professionalism in trading. You can't eliminate emotion, but you can design systems that neutralize it. Hope will always whisper. The difference is, the professional doesn't listen. They don't beg the market for mercy. They follow their numbers. They don't need to be right, they need to be disciplined. They understand that waiting for confirmation beats wishing for redemption. Because once hope replaces discipline, every red candle feels personal. You start taking the market's moves as insults instead of information. You start defending your position instead of your capital. You stop being a trader and start being a believer. And belief is the quickest way to bankruptcy in this game. The professional's creed is simple. Never let emotion decide what your rules should. If the tape disagrees with you, it's not the tape that's wrong. It's your position. Hope tells you to hold on. Experience tells you to let go. One keeps you emotionally attached. The other keeps you financially alive. Most traders lose not because they lack intelligence, but because they refuse surrender. They can't surrender control to their system. They think giving up on a losing trade means weakness. In truth, it's strength, the discipline to live another day. Livermore knew it. Every great trader after him knew it. Markets will always test your conviction, but they reward your ability to execute, not your ability to hope. So the next time you feel that urge to wait just a little longer, remember, that voice isn't patience speaking, it's denial. Cut fast. Protect your capital. Wait for confirmation. Because the moment you start hoping, you've already stopped trading. But if hope is the first trap, the next one is even trickier, because it doesn't feel like weakness. It feels like confidence. And that illusion has destroyed more traders than hope ever could. The most dangerous moment in a trader's life isn't the first loss. It's the first win. That initial taste of profit carries a hidden venom that amateurs rarely recognize. $1,000 in a single trade can inflate confidence faster than a year of study. It feels like mastery, like proof that the hours of charts, patterns, and analysis have paid off. But in truth, the market hasn't confirmed anything permanent, it has merely tested you. Professionals understand that every win is a stress test, a probe to measure emotional discipline. Amateurs interpret it as validation of skill and superiority, forgetting that the market doesn't reward ego. Take the story of Michael, a trader who caught a breakout in a hot tech stock. His account doubled within weeks. For the first time, he felt untouchable. The screens became his playground. He increased his size aggressively, widened his stops, and even started ignoring his exit rules. The market's easy, he thought. And for a brief moment, it seemed so. The thrill of winning reinforced the narrative that he was special, different from the masses who lose. But the market is patient, more patient than any ego can withstand. Within weeks, Michael gave all his profits back and then some. His confidence shattered. His rules, once a foundation, were abandoned in favor of hubris. Jesse Livermore referred to this phenomenon as the delusion of the lucky fool. He understood that profits are seductive, that they blur judgment and inflate the sense of inevitability. Amateurs see success as confirmation that their method works. Professionals see success as a signal to inspect, measure, and verify. The ego wants validation, not truth. It wants applause, not data. And the market, patient and indifferent, waits quietly to test that inflated ego, ready to punish overconfidence with precision. Professionals treat every win with suspicion. They ask, was this skill or just luck? They dissect each trade to understand what worked and why. They consider whether conditions were repeatable or if they just caught a favorable streak. They pyramid slowly, scale cautiously, and assume nothing. Amateurs, by contrast, see profits as permission to take bigger risks. They expand position sizes, remove stops, and chase the next opportunity with reckless abandon. Overconfidence disguised as mastery is perhaps the deadliest of emotional traps because it's invisible until it's too late. The amateur feels invincible. The professional remains skeptical. Every win is a test of humility. Pass it, and you remain in the game. Fail, and you learn humility the hard way, often at the cost of capital. Michael's experience is a classic example. After his doubled account evaporated, he realized that his system hadn't changed. The market hadn't conspired against him. He had let his ego dictate risk, overriding rules that would have protected him. The lesson is clear. Wins teach only if you analyze them objectively. Profit without reflection is a trap. The danger of early wins is psychological, not financial. Amateurs develop the illusion that they are smarter, faster, or luckier than the market. They mistake the temporary alignment of probabilities for a permanent advantage. Professionals know that every streak will end eventually. The key is to survive it. Amateurs chase validation through more aggressive trades. Professionals shrink risk, audit their edge, and focus on process, not outcome. Arrogance is punished faster than ignorance, and the market has infinite patience for teaching that lesson. Psychologically, the first win is seductive because it's tangible, immediate, and emotionally satisfying. It creates a feedback loop. Success breeds confidence. Confidence breeds risk. Risk ultimately produces loss. Professionals understand that probability works both ways. A single win doesn't indicate that the next 10 trades will succeed. The market is indifferent to narratives, desires, or ego. It will continue testing traders' discipline relentlessly. Consider the mental mechanics of overconfidence. When a trade wins, dopamine floods the system. The brain associates risk-taking with reward, creating an invisible bias toward larger, unchecked positions. The amateur interprets this as mastery. The professional interprets it as data feedback to adjust size, timing, and expectation. This distinction determines who survives long enough to compound profits and who self-destructs quickly. The emotional trap of early wins is compounded by social pressures and visibility. Traders often broadcast success, consciously or unconsciously, to peers or social media. The applause reinforces overconfidence, creating a dangerous feedback loop. The amateur craves recognition. The professional craves data. The market punishes the former, rewards the latter. Survivorship bias creates stories of instant success that obscure the discipline behind sustained profitability. Every early win carries a choice: double down emotionally or double down structurally. Amateurs double down on ego, letting past success dictate future behavior. Professionals double down on process, using the win as a calibration tool for position sizing, stop-loss discipline, and risk management. They understand that markets rarely reward emotional bravado. They reward consistency and discipline over time. The first win is merely an opportunity to strengthen structure, not an endorsement of invincibility. Michael's recovery illustrates this. After his account evaporated, he rebuilt with smaller positions, tighter stops, and a renewed commitment to rules. Every trade became a test of adherence, not a bet on the next win. Slowly, he regained confidence, but this time it was rooted in process, not emotion. He learned that the true edge lies not in hitting a breakout, but in surviving the aftermath. Process is the armor, ego is the liability. The amateur mindset post-win is fragile. It views profits as identity. Losses then become personal attacks. Emotional volatility increases. Trades are no longer about probability, they are about ego repair. Professionals, on the other hand, detach outcomes from identity. A winning trade is simply confirmation that rules worked this time. A losing trade is simply information. Nothing is personal. Nothing is permanent. A critical part of mastering the early win trap is journaling and reflection. Every win should be recorded with notes on setup, conditions, size, stops, and execution. Amateurs rarely do this. They celebrate the outcome and forget the process. Professionals analyze it, extract patterns, and refine the method. This metacognition, observing oneself objectively, is what separates long-term survivors from fleeting winners. Another subtle danger is over-pyramiding. Early wins tempt amateurs to add to positions impulsively. Professionals do not ignore a good trade. They incrementally build exposure in alignment with strict confirmation signals. They assume nothing about the future. Each added unit is justified by the tape, never by emotion. This measured approach prevents early success from spiraling into catastrophic loss. The lesson from early wins is clear. Success is a test of humility. It challenges discipline, exposes ego, and amplifies psychological weaknesses. The market exploits this weakness systematically. Those who recognize the risk, tighten their process, and remain skeptical survive. Those who interpret early wins as mastery are inevitably humbled. This is why most traders fail within months of their first big gain. The trap is invisible, seductive, and merciless. Ultimately, the emotional trap of early wins is fear in disguise. Fear of missing out on the next opportunity. Fear that the streak might end. fear that the market won't validate the ego. Amateurs react to this fear by taking excessive risk. Professionals respond by contracting risk, maintaining structure, and auditing the edge. The paradox is simple. Overconfidence is just fear wearing a crown. The market exposes it relentlessly. Every successful trader understands that profits are fleeting and that the process matters more than outcomes. The first win should trigger caution, not celebration. It should prompt reflection, not expansion. The market does not care if you are confident, talented, or clever. It only responds to probability and discipline. Professionals exploit this by letting rules, not emotions, dictate action. So, when you experience your first meaningful gain, pause. Ask yourself, did skill produce this, or luck? Were conditions repeatable, or fortunate? Did I follow the plan exactly, or did emotion sneak in? The answers determine your next move. Amateurs celebrate, ignore lessons, and overcommit. Professionals analyze, calibrate, and reinforce their process. This distinction is what separates survivors from casualties. Confidence, unchecked by discipline, decays quickly. Fear emerges as hesitation, freezing action when the next opportunity appears. This transition from overconfidence to paralyzed inaction is the final stage of the early win trap. It's silent, creeping, and deadly. The trader who was invincible yesterday becomes immobilized today. Recognizing this progression is essential, because surviving early success is a prerequisite to enduring the market long term. But if overconfidence is the shadow of early wins, the next challenge is even more insidious. Fear that prevents action altogether. Once hope and ego have been tested, fear becomes the silent killer, paralyzing traders from entering the trades they know are correct. That is the trap that consumes more potential than any losing streak ever could, and it's the next stage every disciplined trader must learn to navigate. Every trader remembers the trade that scarred them, the one that shattered their confidence and left them questioning every subsequent decision. After a loss like that, entries feel heavier, confirmation feels elusive. Charts that once seemed clear now look like a tangle of numbers and lines. Suddenly, doing nothing feels safe. You convince yourself that waiting is wisdom, that avoiding action will prevent mistakes. But that illusion of safety is a trap. Fear is the third emotional pitfall, the quietest killer of all because it masquerades as prudence. Amateurs hide behind phrases like waiting for the perfect setup or I'll wait for confirmation, when in reality, perfection does not exist. Markets move in probabilities, not certainties. Professionals understand that probability favors preparation, not hesitation. Fear cannot be eradicated, it can only be understood and managed. Consider the case of Ethan, a trader who had just endured a brutal losing streak. He watched a textbook breakout form, the setup aligning with every signal in his system. But memories of previous losses haunted him. He hesitated, convincing himself that waiting one more candle would increase his odds. By the time he entered, the trade had already run its initial move. He tightened his stops out of caution, and the position reversed almost immediately. Another loss hit his account, and with it, a creeping paralysis. Ethan wasn't trading the market anymore, he was trading his memory, replaying previous failures and letting them dictate current decisions. His process, once reliable, became secondary to emotion. The fear of repeating mistakes became a self-fulfilling prophecy. Professionals confront this differently. They redefine fear. Instead of viewing it as a barrier, they treat it as data. Fear signals that size, timing, or context might be misaligned, not that the trade itself is wrong. They respect risk, but do not worship it. Fear, they understand, thrives in ambiguity. The unclear setup, the uncertain entry, the shifting market conditions, all of these amplify fear. The antidote is clarity. Clear rules, defined limits, and a rigid process transform fear from a destructive force into a guide. Structure constrains uncertainty, giving the trader confidence in execution even when the market moves unpredictably. Fear does not disappear, but it becomes manageable. Amateurs often mistake paralysis for prudence. They wait endlessly for ideal conditions, missing opportunity after opportunity. Professionals, however, know that perfection is a myth. No trade will ever align with every criterion in a textbook scenario. Probability demands action within defined parameters. They follow a pre-established plan, using risk controls and position sizing as shields against the unknown. The market does not forgive hesitation. Delayed entries often result in suboptimal positions, higher risk, and emotional distress. By contrast, disciplined execution, even on imperfect trades, maintains both capital and psychological equilibrium. Fear manifests in multiple ways: hesitation, micromanagement of positions, over-tightened stops, and obsession with small losses. Each is a symptom of a mind reacting to previous trauma rather than observing the present. Professionals treat these symptoms as signals. If stops feel too tight, they analyze why. If entries feel uncertain, they review alignment with their rules. They extract actionable insights from fear instead of letting it dictate behavior. Amateurs react instinctively, allowing fear to control sizing, timing, and commitment. Professionals respond methodically, adjusting only where rules indicate adjustment is necessary. The psychological impact of fear compounds over time. Each hesitant trade reinforces self-doubt, creating a cycle that slowly erodes confidence. What begins as a minor hesitation after a loss can evolve into total paralysis, leaving the trader on the sidelines while opportunities unfold. The market punishes indecision. Liquidity evaporates, price moves beyond risk tolerances, and the chance to enter high-probability setups vanishes. Professionals escape this cycle by embedding their process in discipline and structure. Their rules provide a framework in which fear cannot dictate behavior. It can only inform adjustments within a controlled environment. Clarity is the weapon against fear. It requires defining position size, risk per trade, stop-loss levels, and objective criteria for entry and exit. When a trade meets these predefined conditions, action is required regardless of emotion. The moment of hesitation is replaced by the execution of a plan. Ambiguity, which breeds fear, is eliminated. The professional's mind, trained to follow structure, interprets fear as a signal to verify compliance with rules rather than a reason to avoid action. Fear becomes a feedback mechanism rather than a paralyzing force. Consider the example of a trader named Priya. After a string of small losses, she found herself avoiding trades she once executed without hesitation. Each missed setup added to her anxiety. By implementing strict criteria for entries and exits, including fixed position sizing and mechanical stops, she transformed fear into a guide. Each trade executed within her rules provided reassurance, reinforcing the value of her process. The more she trusted her framework, the less fear controlled her actions. She realized that fear could coexist with execution. It only mattered that it didn't dictate behavior. Fear's subtlety makes it dangerous. Unlike hope or ego, it does not announce itself loudly. It creeps into thought patterns, subtly influencing decisions under the guise of caution, waiting for the perfect entry, reducing size unnecessarily, or skipping opportunities are all manifestations of fear. Professionals identify these patterns early and counteract them with clarity and adherence to rules. Execution becomes mechanical, almost detached from emotion, while the trader remains fully engaged with the market's signals. Fear is acknowledged but never allowed to interfere with probability-based decisions. Another aspect of fear is its compounding effect over time. A single hesitant trade can trigger a series of missed opportunities, reinforcing self-doubt. This creates a feedback loop in which fear grows stronger with each perceived failure, eventually freezing the trader entirely. Professionals anticipate this psychological dynamic and design processes to interrupt the loop. Journals, checklists, and pre-commitment rules serve as safeguards against cumulative fear. By institutionalizing structure, the trader externalizes decision-making from emotion to system. This preserves mental capital and maintains engagement in the market without succumbing to paralysis. The key principle is that fear should never be ignored, denied, or suppressed. Attempting to eliminate fear is futile. It is a natural response to uncertainty and risk. The professional's goal is not to eliminate fear, but to reframe it. Fear signals attention, prompts review, and highlights potential misalignments. Acting within a structured framework converts fear from a threat into a tool. Amateurs, conversely, interpret fear as a signal to stop acting entirely. The difference between success and stagnation is this reframing. Even seasoned traders are not immune. Market conditions change, volatility spikes, and positions move against expectations. The emotional response is inevitable. The professional responds with rules, not improvisation. Clarity allows action to continue despite fear. Amateurs falter, overanalyze, or abandon positions, eroding both capital and confidence. The discipline to execute a plan with known risk and probability is what separates survivors from casualties. Fear also interacts with hope and ego. Amateurs, after a loss, may cling to hope to offset fear, or attempt to overcompensate with ego-driven trades. Professionals, however, isolate fear and address it mechanically. They respect risk, acknowledge uncertainty, and adhere strictly to defined rules. This isolation prevents the conflation of emotion and strategy, preserving both capital and mental resilience. Fear becomes a diagnostic tool rather than a prison. Ultimately, the paralysis of fear is a test of process. The market will always challenge traders with opportunities that evoke hesitation. Survival is determined not by absence of fear, but by adherence to a framework that enforces discipline. Fear diminishes in proportion to the clarity of rules and the fidelity of execution. When uncertainty is replaced with structure, hesitation dissolves, and trades are executed based on probability, not emotion. The lesson is simple yet profound. Fear thrives in ambiguity and dies in structure. Amateurs freeze, letting opportunities slip by, haunted by past losses. Professionals follow their plan, converting fear into actionable feedback, ensuring that emotion never overrides probability. Every trade becomes a controlled experiment, every setup evaluated objectively, and every outcome interpreted as data rather than validation or condemnation. But the question remains, how do you build a plan robust enough to withstand not just fear, but also hope and ego? How do you create a framework that neutralizes all three, ensuring consistency under pressure? That is the hidden edge the professionals never reveal openly, and it is the next stage of mastery that every disciplined trader must learn to implement. If emotion is the disease, process is the cure. The moment a trader lets feelings dictate action, hope, fear, and ego immediately take control. Professionals understand this better than anyone. Markets do not reward being right. They reward being consistent. Predicting the next move is a fool's game. Preparation, adherence to rules, and structured execution are what distinguish survivors from casualties. Amateurs want to be heroes. They chase the next breakout, try to prove their insight, and react impulsively to price swings. Professionals want to survive. They accept that trading is about repeated, disciplined action rather than spectacular single trades. The secret lies not in prediction but in process. Fixed risk per trade, stop-loss discipline, and pyramiding only when confirmation is present. These are not just tactics, they are psychological armor. Take Jesse Livermore's famous principle, be right, sit tight. On the surface, it sounds like stubbornness. Many amateurs misinterpret it that way, thinking that one should hold at all costs. But the essence is alignment, waiting for the tape to confirm your analysis, not your opinion. The market moves independently of your judgment, and patience in proper context compounds profitability. This mindset converts chaos into opportunity. The trader who rushes is a gambler. The trader who waits according to rules is a professional. Discipline, not intuition, dictates action. I once mentored a trader, Daniel, who had suffered 3 consecutive losing weeks. The losses had rattled him. He wanted to revenge trade to make up the deficit. Each new setup seemed like a chance to reclaim control, yet every attempt was impulsive. I told him, "You don't trade to make money. You trade to make good trades." That phrase became his anchor. He returned to his process, fixed position sizes, precise stop losses, and trades only executed with clear confirmation. In the fourth week, his profit was modest but clean. By the fifth week, the gains grew, and by the sixth, he had regained consistency. His confidence returned, not because the market had changed, but because his process remained unbroken. The amateur reacts, the professional rehearses. Process transforms trading from chaos into craft. While markets remain volatile and unpredictable, disciplined behavior produces stability and compounding results. Every trade executed under structured rules strengthens the trader's psychological framework. Every rule consistently applied reduces exposure to hope, fear, and ego. By contrast, amateurs constantly chase outcomes and let emotion dictate risk. They move stops, over-leverage, or ignore confirmation because their perception of probability is clouded by desire or fear. Professionals avoid this trap through predefined systems. The process becomes an internalized shield, preventing psychological weaknesses from dictating behavior. Structure is multidimensional. First, fixed risk per trade prevents a single loss from destroying capital. Second, stop-loss discipline ensures that losses are small and predetermined. Third, pyramiding on confirmation allows for scaling exposure without increasing vulnerability. This methodical approach turns trading into a mechanical, repeatable discipline. It does not eliminate losses, but it ensures that every loss is survivable and every gain is repeatable. Amateurs see these tactics as constraints. Professionals see them as enablers, the framework within which they operate optimally. Every professional trade carries an implicit mantra: follow the plan, ignore emotion, and observe results objectively. The market's chaos never changes. What changes is the trader's behavior. Adherence to rules creates a feedback loop that strengthens decision-making under pressure. Each execution under a defined process reinforces trust in the system and reduces the likelihood of deviation under stress. Conversely, deviation increases vulnerability to emotional traps. Discipline compounds over time, creating a mental and financial buffer against the market's inherent unpredictability. Consider the psychological relief this brings. Fear of missing out, hope for validation, and ego-driven impulses all lose their potency when the trader's actions are governed by rules. Each trade becomes a controlled experiment, evaluated on criteria established before entry. The result is clarity under uncertainty. The professional can act decisively without emotional interference. This clarity transforms potential volatility into structured opportunity. Every execution reinforces confidence, not ego, and this consistent application over time produces lasting results. Process also moderates reaction to losses. Amateurs often respond to loss with revenge trading or deviation from strategy, seeking to compensate emotionally rather than systematically. Professionals respond within the framework. Losses are treated as data, not judgment. They indicate whether rules were followed correctly, whether market conditions aligned with the strategy, or whether position sizing requires adjustment. The loss itself is not personal, preventing the spiral into fear or hope-driven behavior. Emotional neutrality is maintained because process, not outcome, defines performance. The professional's shield works even in volatile conditions. When markets spike, gap, or crash, the system dictates position size, stops, and risk management. Emotion is secondary to execution. The trader becomes an observer and executor, not a participant in the drama. This is the edge amateurs lack. They react to price action as if it were personal. Professionals understand that survival and consistency matter far more than individual wins. Markets are inherently indifferent. Structure converts that indifference into opportunity. Another advantage of process over prediction is scalability. With a structured system, the trader can repeat setups under varying conditions without the need for subjective judgment. Each trade is an iteration of the framework, reinforcing consistency. Amateurs, reliant on intuition and prediction, struggle to replicate success as emotional interference distorts decisions. Professionals, by contrast, create a predictable, repeatable methodology, which is the foundation of compounding both capital and confidence. Reinforcing process requires continuous reflection and feedback. Journaling trades, analyzing adherence to rules, and reviewing outcomes ensures that the system evolves and adapts without being hijacked by emotion. Professionals internalize these reviews as opportunities to refine structure, not to validate ego. Amateurs, however, interpret wins as proof and losses as failure, often ignoring lessons or altering strategy impulsively. The structured professional separates learning from ego and outcome from emotion. The mantra, "Be right, sit tight," encapsulates this philosophy. Sitting tight is not inaction, it is disciplined observation, allowing the trade to develop according to rules. Being right is not about predicting the market's next move. It is about validating that the trade meets established criteria. The combination ensures patience aligned with probability. Amateurs often confuse inaction with weakness, but the professional recognizes that measured patience within structure compounds advantage over time. The professional mindset transforms the psychological landscape. Emotional triggers lose their power. Uncertainty is converted into a controlled variable, and probability becomes the guiding principle. This approach neutralizes hope, fear, and ego simultaneously, providing a durable edge in an unpredictable environment. Process becomes not just a tool, but an identity. The trader is someone who acts according to rules, not impulses. Yet maintaining this discipline over time is challenging. Market conditions fluctuate, volatility spikes, and unforeseen events occur. The professional's advantage lies in a process resilient enough to absorb these shocks without deviation. The focus is not on individual outcomes, but on repeated high-probability execution. By consistently following the framework, even during turbulent periods, the trader maintains mental equilibrium, preserves capital, and compounds results. The difference between amateurs and professionals is stark. Amateurs attempt to predict, react, and prove themselves to the market. Professionals prepare, follow process, and survive. In this framework, success is measured not by individual trades, but by consistency, survivability, and psychological resilience. Discipline becomes the lens through which every market movement is filtered. Emotional traps lose their potency, and execution becomes mechanical without being robotic, deliberate without being rigid. Ultimately, Process over prediction is the professional's shield. It neutralizes hope, fear, and ego by externalizing decision-making to rules and structure. Execution becomes the measure of competence rather than outcome, and survival becomes the metric of success. The market remains chaotic, but the trader becomes disciplined, patient, and resilient. Preparation replaces prediction, and clarity replaces anxiety. Every trade reinforces the system, and every outcome, positive or negative, provides feedback to strengthen the shield. The next question naturally arises: how do you maintain this mindset when the market becomes wild, when volatility spikes, when emotions run high? That is where the final piece of mastery comes into play: how professionals sustain discipline over years, compounding both capital and psychological resilience to survive and thrive under all conditions. Discipline compounds like capital. Every rule followed strengthens confidence, every deviation weakens it. Professionals understand this principle intuitively. Consistency breeds calm, and calm breeds clarity. Every mechanical execution, every adherence to predefined stops, and every patient observation of the tape reinforces the trader's mental framework. Amateurs, by contrast, chase outcomes. They celebrate wins emotionally, dwell on losses excessively, and allow results to dictate behavior. Professionals, however, focus on habits, on process, on execution, on repeated application of principles that survive all market conditions. In trading, discipline is the ultimate compounding engine, more reliable than luck or intuition, because it produces leverage over time that money alone cannot buy. Jesse Livermore famously said he made his largest profits by sitting. Many take this as passive advice, but sitting in this context is the apex of active restraint. Sitting is prepared waiting patience as a tactical weapon. Every trade that doesn't meet strict criteria is a position in itself. The market is always moving, and the trader who is disciplined understands that sometimes the best action is deliberate inaction. Waiting becomes a position just as legitimate as any long or short exposure. The professional knows that the tape will eventually align with probability, and that capital preservation during misalignment is more valuable than chasing every fleeting opportunity. Sitting, in this sense, is proactive, not passive, a calculated defense that compounds over time. The true edge in markets is not prediction, it is emotional asymmetry. Professionals cultivate the ability to feel little when they win and almost nothing when they lose. This neutrality is the dividend of discipline. Emotional detachment allows for objective evaluation, reduces unnecessary risk-taking, and prevents hope, ego, or fear from distorting decision-making. Amateurs, on the other hand, ride emotional waves, oscillating between thrill and despair. This imbalance ensures that mistakes are magnified and profits are fleeting. Emotional asymmetry, staying steady through wins and losses, is what separates long-term survivors from the majority who are consumed by the market. The compounding effect of discipline manifests in both behavior and capital. Each day, a trader executes their plan without deviation. Their confidence strengthens. Their decisions become predictable, deliberate, and aligned with probability. By contrast, a single day of impulsive trading introduces doubt, weakens confidence, and begins a subtle erosion of the system's integrity. Professionals treat each trade as a rehearsal of their methodology, reinforcing neural pathways associated with calculated action. Amateurs, lacking this rigor, oscillate between impulsive reaction and regret, never establishing consistency. Discipline also transforms the perception of loss. A properly sized and managed loss is no longer a failure but a controlled learning event. Professionals recognize that losing trades are data points, not emotional verdicts. Each small loss validates the process. Stops worked, rules were followed, and capital was preserved. Amateurs, however, interpret losses personally, compounding emotional stress and creating hesitation for future opportunities. The discipline dividend, therefore, is both psychological and practical. It strengthens decision-making while preserving capital. One critical manifestation of this discipline is in trade execution under stress. Market volatility often tempts amateurs to abandon process in search of quick wins or to recover previous losses. Professionals, in contrast, view volatility as an opportunity to adhere strictly to their rules. Extreme price movement does not alter position sizing, stop placement, or entry criteria. The market may fluctuate wildly, but the disciplined trader's behavior remains consistent. This consistency, repeated over thousands of trades, compounds into sustained profitability and psychological stability. Prepared waiting, emotional asymmetry, and structural adherence converge into a single principle. Survival is the ultimate measure of success. Professionals understand that markets do not reward ego, bravery, or luck. They reward persistence, risk management, and execution. The three emotional traps, hope, ego, and fear, are all reflections of the same underlying weakness, the desire for control. In a game that punishes control obsessively, professionals surrender control to process, not prediction, understanding that consistent adherence to proven principles ensures survival and eventual profit. Amateurs fight against the market, attempting to impose control over price action, and invariably fail. Another critical aspect of the discipline dividend is the creation of freedom. Once emotions are mastered, trading ceases to be a roller coaster of excitement and despair. Professionals trade not for thrill but for freedom. Freedom from compounding stress, freedom from impulsive decisions, and freedom to let probability work in their favor. With process as a shield, the market becomes a neutral arena in which calculated actions, not reactions, determine outcomes. Patience is no longer a test of will but a strategic choice. Inaction becomes active, measured, and profitable. Cutting losses fast, sizing positions appropriately, and waiting for confirmation are the pillars of this approach. Professionals internalize these principles so thoroughly that following them becomes reflexive. This reflexive discipline allows for engagement with the market without succumbing to emotion. Each trade reinforces the habit of detachment, strengthening confidence in the process itself. By contrast, amateurs compromise these pillars with emotion-driven deviations, ensuring that every opportunity is either overexposed or missed entirely. The 5% of traders who survive understand this intuitively. They are not superior in intelligence or insight, but in process fidelity and psychological resilience. Discipline also compounds through repetition. Each trade executed according to rules reinforces the neural and psychological structures required for calm, deliberate action. Over weeks, months, and years, this repetition embeds a sense of inevitability. Profitable decisions follow disciplined execution, and losses remain contained and manageable. Amateurs, lacking such repetition, experience inconsistent outcomes and amplified emotional reactions. The professional's edge is the compound effect of disciplined actions, producing both financial stability and mental clarity. The relationship between discipline and emotional neutrality is particularly powerful. By reducing the psychological weight of individual outcomes, the trader can approach each new opportunity with fresh evaluation. The tape becomes data, not judgment. Traders no longer measure self-worth by profit or loss. Instead, they assess adherence to rules and alignment with probability. This detachment allows for consistent decision-making regardless of market conditions, ensuring survival through streaks of losses or periods of volatility. The discipline dividend ultimately bridges all previous lessons. Hope is neutralized by predefined risk and stop losses. Ego is contained by reframing wins as process validation rather than personal achievement. Fear is addressed through structure, clarity, and mechanical adherence to rules. Each emotional trap is mitigated not by willpower alone, but by a comprehensive system that compounds strength over time. The professional's mind becomes a stable platform from which calculated actions can be executed without interference from psychological distortion. The final payoff of this discipline is freedom and longevity in the market. Professionals can endure drawdowns without panic, execute trades without emotional hijack, and grow their capital without impulsive exposure. Amateurs, by contrast, are at the mercy of each tick, each emotional swing, and each market narrative. The cumulative effect is stark. Over time, disciplined behavior compounds into sustained success, while emotional deviation compounds into repeated failure. Discipline is the lever that magnifies both capital and psychological resilience. In conclusion, the principles of process over prediction, emotional asymmetry, prepared waiting, and mechanical adherence converge into the discipline dividend. Each rule followed strengthens the trader's foundation. Each deviation erodes it. Survival, consistency, and clarity become measurable outcomes of applied discipline. Once mastered, these principles allow the trader to detach from individual results, engage with the market objectively, and protect capital effectively. Survival is no longer a hope or aspiration, but a predictable outcome of systematic behavior. Cut losses fast, size small, wait for confirmation, trust your plan. These are not platitudes, but operational imperatives. That is how the 5% stay alive while the 95% self-destruct. Once discipline is internalized, the market is no longer a threat, but a mechanism for compounding both capital and skill. Traders evolve from participants chasing outcomes to observers leveraging probabilities, from reactors driven by emotion to operators empowered by process. If you've learned how to avoid destruction, the next stage of mastery is building endurance, trading through inevitable drawdowns without losing the psychological edge. The discipline dividend compounds over time, and understanding how to preserve it during adverse conditions is the ultimate path to consistent success in markets that remain unpredictable, indifferent, and brutally efficient.